commodity trade finance. This time, not let's say the conventional side as we addressed about 6 months ago, but much more interesting, or yeah, maybe much more interesting and maybe more a currently important issue, the alternatives, because we all know the traditional side. Probably many of us experience the problems we have on the conventional side of commodity trade financing. So it's even more important now for today's session to hear about the alternatives. For that, Harris, I hand over to you.
Yes, thank you very much, Martin. Good afternoon, everyone. It's great actually to be able to organize the second session on trade finance. The first one was a success, and I hope the second one is going to live up to the expectations of our participants. And I'm pleased that actually, more and more people are joining these events. In fact, today, we're going to talk about alternative funding in support of trading. And we have with us, three panelists that are well known in the industry, and they're coming from a cross section of servicing, funding, and trading. I will start with Aaron Charit, who's heading Aon's Credit Solutions team, and is leading a team of professionals that provide a range of risk, reinsurance, retirement, and health solutions. I would like to also ask you generally to keep. I would like to ask you to actually put your computers on mute if you could hear me. If you're not speaking, put please your device on mute so we don't interfere with the speakers. I was actually introducing the speakers right now. I introduced Aaron, who's head of the Aon's Credit and Capital Solutions team. And he's going to actually have time to give us a presentation about what they do and how insurance can play a role in enhancing the way people can get access to capital in the commodity industry. We have Alexander Peters, who is the Group Chief Executive Officer at Arrow Resources. Thank you, Alexander, for being with us. He's been many years in the financial industry and the commodity industry, having worked for a number of very well-known commodity houses. And of course, he's going to give us the trade finance perspective from the user's angle. And we have Chris Tremaine, who's the founder and CEO of Kimura Capital, who actually started as a trader, but then I suppose he saw the light and moved on to the finance side. And he's going to talk to us about asset management and how alternative credit is going to actually fill the void that banks left. In fact, it was about 6 months ago that we had a previous session, and I was kind of scared because I saw banks moving away from the industry. We were just coming off the crisis that was caused by the pandemic and the total collapse in prices that we saw back in March. Now, I think I have to say that I'm much more optimistic because number one, we are talking about alternatives. Number two is because we see huge opportunities in front of us as a result of the fact that we're coming out of the crisis, the corona crisis, and the world seems to be getting back on track. But also because of the fact that 2020, in fact, was a tremendous boom, bumper year for commodities and commodity trading. And some of the commodities, in fact, are trading at all-time highs. So it seems that we are dealing with sort of a trifecta effect with higher demand, lower supply, and a lot of liquidity. let's just discuss how these affect our commodity business. In fact, I would like now to move on and give the stage to Iran, who's going to give a short presentation about insurance solutions, and then we're going to move on with our discussion about the topics that I mentioned earlier. So, Iran, the floor is yours.
Thank you very much, Harris. Just 1 second as I load the presentation. And thank you very much for the Two Commodity Association for inviting us today to speak to you guys. It's an interesting topic, given everything that's going on around the world. Before we dive specifically to alternative finance, what I wanted to give those joining us today is really just a stop whistle view of what has happened in the credit insurance market in the last 12 and a bit months and how all of that has impacted access to funding. So I'll give you a quick overview, and then at the end I'll just talk about some recent development and how we've been positioning credit insurance to enable traders and corporates to have additional access to funding and improve the working capital. So before I jump in, I mean, just for those of you who are not aware, credit insurance has been around for decades. I would like to think most of you are using it in one form or another. The big shift in our industry happened following the global financial crisis. Was prior to that, the majority of users or buyers of credit insurance were the corporates and the traders. And what we saw in 2009 and 10 is that there was effectively a runaway from people buying it themselves and just going to banks and saying, look, I don't want to hold any risk. I want to get everything financed. And what we saw then was a big shift in our market from banks and funders not playing such a major role to them effectively now becoming the main buyers of the product. And the product has gone through very extensive development and improvements on the back of that, with the banks and the funders coming with a different level of sophistication. And the reason really for the banks to buy the product is it's a simple ability to either offload concentrations, so whereby you'll be asked by several of clients to cover or finance the same risk or the same buyers. At some point, they get to a limitation of how much they can swallow. So it's just another route for syndication. And the other reason, which has really seen rise in the last 5 years or so, is capital arbitrage. So to keep it very simple, if a bank is lending against an asset which is rated internally as BB, having a credit insurance policy in the background provided by a AA rate or A+ rated company makes it a lot more attractive proposition for them. So they can lend against it at a much more attractive price. That is the long and short of it. Now, what we're seeing again is alternative funders are coming in, although they're not sitting under the same regulations as the regular banks. They are starting to have a conversation around how they can use the product in a similar way to the traditional banks. So I'll just give you a very quick overview of what we saw in 2020, which has been a strange year for all of us. Even before COVID, the market was hardening. When we say the market is hardening, is another way of saying rates were going up. And it was a combination of different events happening across the globe, not specifically in terms of finance, but more across general insurance lines. So we walked into a market in 2020 where we expected prices to go up. And then quite early on in Q1, we saw the defaults across Singapore trading houses, which were really starting to scare a lot of the underwriters. So there were some big losses, specifically in Hin Long and other trading houses in the region, as well as some smaller losses in the MENA region. And then we had COVID. So all of a sudden, from a market that was expecting, more demand, higher pricing, we effectively had a complete shutdown in Q2. And the expectation was that we'll have a replay of what happened in 2008, 2009, where there's going to be very sharp decline and we're going to have lots of insolvency hitting us from all directions, or as the underwriters call it, death by 1,000 cuts. The main difference last year and continuing throughout this year was in 2008 and 2009, the governments were very slow to react. They were effectively using quantitative easing. What we've seen this time around is the governments realized that having credit insurance in the background is paramount for continuing to trade, especially during lockdown. So what a lot of governments have done is they effectively provided a backstop for the credit insurance market. So they went to the credit insurers and said, we will guarantee your payments. As in, if there's any insolvencies, come to us, we'll pay it for you. And what that allowed underwriters to do is to continue writing limits rather than canceling them. And again, in the last financial crisis, the main issue was underwriters simply pulled out limits. People then unable to access funding, people decided to stop trading, and then companies just very quickly collapsed. The other thing we saw was also the relaxation in specific countries in terms of insolvency regulations and who had to file for insolvency when. So you had companies continue to trade throughout lockdown, even though they might not normally be trading in such environment. On the back of that, underwriters kept on providing limits. The market came back in the summertime. It didn't go back to the level that it was pre-COVID, but it was a much quicker recovery than anyone expected in terms of what underwriters were willing to do. What we did see is what we call a flight for quality. So a lot of the more difficult risks and the more niche risks were effectively left untouched. And there was a big rush into better rated risks. And what we also saw at the time is the big banks coming into the market and showing uninsured risks previously. Again, there was a lot of uncertainty in the market. What will happen to even, very well-rated companies in the region of the triple Bs and the As? So the banks came in and said, look, I would like to just hedge myself. So there was more risk coming into the market, but of a better quality. Coupled with that, we also saw the price increases. So underwriters were able to exert higher prices. They were able to get better risk. And at the back of it, they saw no insolvency. All of that led to an absolute bumper year also for the underwriters in the credit insurance industry, where they had revenues going up, but effectively losses were going down. So despite everything that was going on in the world, 2020 was an excellent year for underwriters. This is a little extra I took from the Berne Union. The Berne Union is an amalgamation of different export credit agencies as well as private insurers. And you can see how insolvency rates throughout 2020 were extremely low. So again, the government actions that was taken artificially lowered the insolvency rates. Now, the big question that we're all asking ourselves is, how real is this? And have we only kicked the can down the road? As in, when these government support schemes and when the quantitative easing and the money printing machine stops, are we going to see lots of insolvencies, or are companies healthy and we'll be able to weather the storm? We simply don't know. But that is the big question and the big unknown. Another statistic I just wanted to share with you is the performance of this class. Because what we saw again in 2008 and 2009 is there was a big fear that people will pull out of it and won't provide the capacity needed and won't provide the insurance needed. If you look at the historic loss ratios, and I'll just walk you through this. So the blue is effectively premium earned, or how much they're earning. Red is the losses. And then the green line is the loss ratio. Now, that is effectively the difference between money in versus money out, to keep it very simple. So we're saying during the financial crisis, from all the money underwriters collected, on average, 80 to 90% was paid out. Now, you might think, well, that's great because that means it's less than 100, as in they're making money, but that doesn't take into account any external cost. This is purely just losses. So when you're trading at that level, add to that staff cost, HQ cost, and all the other things, effectively that means they were running at a loss. So with the exception of the financial crisis, every year since then, they were making money. That's the long and short of it. So they had a 10-year run whereby they were able to generate enough premium cushion to sustain them for any big losses. The expectation is, again, there'll be a jump in 2021 and 2022 as when the losses start rolling in, but we're not expecting any mass exodus, because overall, as an investment, this is still remaining a very, very profitable class of insurance for a lot of the capital being provided to the market. So we're not expecting any big change in terms of who's doing what, but we'll definitely expect change in terms of what is being written. In terms of what 2020 is looking so far like, the trend continues. We're seeing higher premium rates across the board, again, on average about 10 to 20%. The flight for quality remains. So there is, again, this push for better risks overall. And the one thing we've really seen is the focus on core client. But to be fair, that's not different to what the financiers are doing. So whereas previously you might have had the classic 20-80 rule, 80% of your income comes from 20% of your clients, I think now it's more like 95-5. So the underwriters are really focusing on the clients they know well, the client they trust, and the client that they think will weather the storm. What we still don't know is how big and when the losses are going to come and if they're going to come. The analogy I often use is we're currently standing on the beach. The water is receding. We know the tsunami is coming, but we have no idea how big it's going to be and when it's going to hit us. So there's still a bit of cautiousness in the market in terms of we shouldn't be tempting faith, and we should just kind of hold the line and not write anything too exotic. Having said all that, things are starting to change. So we have seen quite a few new entries to a market in 2021 already. When we talk about the world of credit insurance, we speak about 60+ underwriters, as in companies who can provide us products. This year, we already saw 5 new companies joining us. And again, it's a testament to the fact that investors believe this class is going to last and going to hold, and the returns are there. And the key thing is, how do we think differently about what credit insurance is? So this is where it gets a bit more interesting in terms of what is the credit insurance does nowadays, particularly in our space. And this one, I'm going to give you some examples. So credit insurance as a product is nothing new, right? And it's not been changed for many, many years. It's effectively a case where you have an insurance company providing cover should an obligor or your trading partner default on a payment obligation, right? Very simple. You trade, you give a credit terms. If somebody doesn't pay you, you call up your underwriter and say, hey, had a default, please pay out. It's been sold like that for the last 50 years. It used to be the case of people being scared into buying it. The idea was, well, can you afford to have an invoice not paid? And that was all fine. As I mentioned in the beginning, the big change has been the involvement of funders. So with funders coming into the space, credit insurance really developed into a new product and to an improved product. And what we've seen is the application of credit insurance into unlocking additional funding. So I'll just give you some examples relevant to our space and to the commodity space where credit insurance was a complete trade enabler. So one example we like to use is we had a soft trader, which never bought credit insurance. You know, they said, we know our clients extremely well. We've been dealing with the same guys for the last 50 years. We trust them not to default. We then spoke to their bankers who said, well, I'm lending to them at a certain rate based on the perceived risk of their receivable portfolio. So we then had a conversation between the trader and the bank, and we put a proposal forward, said, look, if we wrapped your receivables, what would that do to your borrowing rate? And the bank said, well, if you get us a credit insurance wrapper from a AA rated company, we can definitely reduce your borrowing cost. So we did that, and then effectively the bank has agreed to reduce the borrowing cost by 100 bips. So the credit insurance was more than covered by the reduction that was achieved by the credit insurance policy being issued. So effectively we got a better rated risk, and it was for free. And the bank was willing to lend more to our client. So you know, it was a win all around. Everyone was extremely happy because who doesn't like to pay less and just get additional lines on that. So that worked extremely well. On the back of that, the trader kept on buying more insurance and the bank kept on providing more funding. That is when we do the portfolio play and you have an underwriter who's willing to cover your receivables. Sometimes, however, we come across situations where one of our clients has an existing portfolio cover, but the incumbent is not willing to extend cover in a particular counterparty, especially if the counterparty is a bit more of a difficult one. So we had a situation last year, one of our clients came to us and said, look, I have a policy with underwriter X. I have this very important client of mine who is asking me to extend our credit terms because of everything that's going on, but I'm just not able to do that because internally I don't trade unsecured. Unsecured being either backed by LCs or having credit insurance and having the financing. So within that instance, we went out to the wider market and we were able to secure what we call a single risk policy. So just one specific buyer was insured. It was then, it was effectively a limit of just shy of 20 million euros. We took that, went back to our client and said, look, we can structure this. Tell us who is the lending bank who is going to do that. They were asking around lots of different funders, and ultimately they end up with an alternative financier who said, you know what, on the back of the credit wrapper that you put, I'm comfortable lending against this specific buyer. So again, we managed to secure something which is a bit unusual, and everyone was happy because the client is in a supplier supplier was able to get the funding up front. The buyer was able to get extended payment terms on the back of the financing, so they improved their own cash flow. And the alternative financier got some additional piece of business. On the back of that, we've grown the portfolio and we've done more than just the one name. So that's just to give you an idea of what we do around the trade receivables. The trade payable is also an interesting one because that is nothing more than a flip on traditional credit insurance. So what we mean by that is we have clients coming to us and saying, look, I want to buy more from my suppliers, but my suppliers are telling me they're not able to give me more because either internally they don't trade uninsured, or the banks are not giving them sufficient credit limits. So we've done several times in the past is we take our client to market, we put together a presentation, we speak to the credit insurance market and say, look, this is the client. You might not be aware of them, or you might have come across them in the past, but they're looking for additional capacity on themselves. So once we get additional capacity on them, we go back to them and say, well, tell me which supplier you would like to give this capacity to. So we had a case 2 years ago where a particular, it was a metal trader who said, look, I want to buy more from this specific supplier, but they're struggling to give me above 60 million. Can you give me more? So we went to market. We found an additional 120 fresh capacity. We took that capacity, went back to the trader and said, okay, which supplier do you want to give it to? He put us in touch with a supplier, and we then structured a specific policy around that risk, as in our client and the supplier. The supplier was then able to get the financing in the back of that product, because again, it was issued by a AA- rated entity. And that increased their volume of trade with our client. So the client then was able to trade and purchase a lot more, which was key for them. They improved the working capital because they didn't have to turn around their amounts that quickly. We went from the 60 million to 120 overnight. And the supplier was also thrilled because they got additional volumes of sales in. And we did it on a quite regular basis where it's all about, presenting the risk to the market. So a lot of times underwriters just sit there and don't necessarily understand the company. All they see is just the black and white financials. So it's all about offering these intangible touch points that the underwriters can get comfortable with and really understand the business and why they should be underwriting that. That's on the payable side. That's something that we've done successfully in the past. The last bit I just want to mention today is collateral replacement. And this is, I think, the secret weapon that not enough people know about. So there is a product within the credit insurance space, which is called surety bonds. Some of you might have come across it because it's usually used within construction projects. So quite often when you have an EPC contractor be asked to put up either a bid bond or performance bond, and you can have an insurance company issuing that. However, a surety bond can effectively be used as a one-to-one replacement for a bank guarantee, right? It's usually it's using the same text. The only difference is that rather than being issued by a bank, it's issued by an insurance company. And what we've seen a real rise on this is using these surety bonds in situations where people don't normally associate it with just a pure credit risk. So I'll give you an example. We had a situation where one of the traders that we're working with was posting collateral in the sense of actually hard cash under a credit support annex. And we had a conversation with a counterparty and said, well, is there any reason why you wouldn't accept a surety bond? As in if it's issued by A+ rated insurance company, would that be acceptable to you? The buyer went away, had a bit of a think about it and said, well, if it's using this text and it's an on-demand bond and it's issued by that rated company, absolutely no issue. So what we then did is we got the insurance company to issue that bond on behalf of our clients, and they were able then to take back that cash collateral that was sitting there. And we're seeing lots of different application of these surety bonds. So we see them now being used for exchanges. So we have several exchanges whereby the trader would be required to put collateral up, be either a bank guarantee or cash. Again, surety is accepted by certain exchanges. And we're also seeing it in terms of supporting additional trade. So it could be issued either to a supplier or it could be issued to a buyer. Again, any place that is requesting for a bank guarantee, there's no reason why surety bond cannot be approved. So I appreciate that, I was throwing a lot at you, but I just wanted to give you a bit of a general idea of what is now available in the credit insurance market and all the other things we're seeing. Harris, I hand over to you.
Thank you, Iran. That was quite useful. Thank you for the presentation. In fact, it brings up a point again, which is high up on the agenda of many of our participants, I suppose, and commodity traders as a whole, because you use the words flight to quality, core clients, and high rates to describe what happened in the market last year, which means, again, obviously, there may be, it seems to me that there may be an interesting, product, but at the same time, if it is again targeting the top end of the market, we still have the question of, how do you fund the SMEs of the world, if you will, in the commodity industry, which is, of course, something we're going to cover later. So that's question number one. And question number two is in your collateral replacement product, the surety bonds, what type of actually security do insurance companies ask to provide this type of bonding? And then I would open it also to Alexander, who's coming from the user side, to also give us his views on these particular issues. And I would also like to make one more point. If the audience has questions, please put them on the chat, and we will be going through them regularly, to find out the ones that are relevant to ask at that particular point in time. Thank you. So, Aaron, do you want to comment on this?
Sure. So to your first point, you're absolutely right. I think, again, we saw very much expectedly in Q2 and Q3, the market was just in flux. No one really knew what's happening. So there was a bit of a just sit there tight and don't do anything mentality. Having said that, we have found that the market has come back, not fully to the way it was pre-COVID, but probably it's fair to say it's back to 80 or 85% where it was. So in terms of the very, very difficult risk, so things that are going either to dangerous countries, let's put it this way, or where it's a new startup and there's not enough financials information there, yes, that is still a bit of a struggle for the underwriters to underwrite. That is no different to the good old days, I would say, pre-COVID. But there's definitely a lot more emphasis on understanding your client. And I think that's the key thing that we're seeing more and more, and especially during COVID, is that if you're able to come to the market and present yourself, because again, this is everything that we do tends to be in a panel, right? It's rare that we do one transaction with one underwriter. It tends to be spread around, with the exception of portfolio, which tends to be a bit of a different play. Once the underwriter and the market understand the way that a company operates, they understand the operating model, and they understand the sort of the credit metrics to have in place and how they themselves perceive risk, they will start feeling a lot more comfortable going down the credit curve. So where you will start from doing, the plain vanilla, straightforward stuff, very quickly demonstrating the right behavior, you can actually unlock additional insurance capacity. It's not a quick fix, it's not as if that you go to market and then within a month you get it. But again, it's a journey, and that's a journey where us as the brokers are very much heavily involved in persuading the markets to do that. So it's available. It's not straightforward, but it's definitely achievable. On the second point, the question about the surety, the way that works is the underwriters who issue the surety bond on behalf of the clients will then have an indemnity agreement going back to the trader. So effectively, they will sit quite often pari passu to the banks in terms of what security they're getting. And they would expect, if the bond is called, just the way the bank guarantee is called, they will come to you and say, okay, I've paid this on your behalf. I'm expecting to be paid back. The other main benefit that I mentioned is quite often when your banking lines are full and you're unable to get any more bank guarantees issued, surety gives you nice diversification away from these bank guarantees. So we had situations in the past where clients had, let's say, 100 million facility, of which 20 million was allocated to bank guarantees. All of it was fully utilized. We then replaced the existing bank guarantees with sureties, which then gave them back the headroom under the funding facility. So it's not necessarily too different to bank guarantees. It's all about how do you use it to release available funding into the system.
What do you think about all this, Alexander?
The quotation of 2020, you're on mute. absolutely can relay, to what Aaron said, and this is pretty much what we are also doing. We have identified sureties also to be a very useful instrument. And again, to run exactly the same example that Aaron just has presented us, if you have certain limits on bank guarantees and LCs, standby LCs, whatever kind of performance guarantee you would provide, to any of your counterparty, you can easily replace it with a surety. Obviously, this easily, has to be told, with all the caveats around that. Obviously, provided that you have sufficient creditworthiness, to be rated at that. It works pretty much like credit insurance, whereas you are not on the buy side where the credit insurer is insuring the receivable and your default risk. Here is pretty much ensuring your performance risk on a specific item. But then again, it's very useful interest because you can diversify your funding portfolio, including insurance companies on top of your existing bank pools. And especially on our side, in the oil and gas realm, especially also natural gas, crude oil, where you have to issue quite a lot, this kind of performance guarantees. This is a very useful instrument.
And in terms of pricing, it seems to me that it's equally competitive, I suppose, to what the banks are offering. So
it's equally competitive, and in certain cases even lower than that.
Mm-hmm.
So because obviously, now we can trigger another discussion, which is not part of this forum. What's the cost of risk capital for insurance companies as opposed, to banks? Probably, the insurance expert in the round may weigh in. But again, in certain cases, we have seen that even a surety would be priced lower than a bank guarantee.
I see. So I suppose, it is an interesting instrument for companies to use. I note that, in fact, again, in today's environment, is not necessarily easily available to the SMEs of this world, which begs the question: how are these SMEs are going to fund themselves, and especially, in an environment, a trading environment, which seems to be, picking up rather nicely. As I mentioned at the beginning of the discussion, we had the absolute meltdown back in March, but mostly because of the stimulus that we've seen in China and the infrastructure spending. We had a turnaround, and we are seeing now insatiable appetite for commodities. Iron ore, copper, etc. Other commodities are running at all-time high prices. Alexander, do you think this? What do you think of this upcycle and the opportunities that is presenting?
It's obviously as a direct consequence, of the COVID-19 impact, and also, the fraud-driven defaults that we've seen in the market, in the commodity space in 2020, and even, chasing us down now in 2021. What we've seen is obviously, banks are retrenching, with credit lines, and so far we have seen this rather on our side as an opportunity. Because as a lot of bankers would say, it's rather flight to quality, because bankers do have their deposits. They need to remunerate, to their deposit keepers. So at the end of the day, they still have to produce P&L in order to be able to compensate the saving accounts. On the other side, obviously, given what's happened in the market, the sentiment has changed. So the covenants has changed. Banks have started to lend, more on a more selected way, increasing thresholds on minimum tangible net worth on specific traders. When I say traders, in general, the sentiment in the market is less appetite on traders and more on producers, or on traders with very strong balance sheet, with already, a successful track record in the market, and with high transparency of their business models.
And how is this going to affect? I mean, for you, your company has grown significantly over the last few years. You entered into sort of new markets, so that is obviously a market which is probably positive for you because you've been able to access sufficiently capital. But again, it doesn't really necessarily help smaller companies. And Chris, perhaps you can jump in here because we would love to hear your views on how you see there you go, we see you now as well. Because as a matter of fact, it is a question in this environment with increasing commodity prices and more trading, which is probably going to be the case going forward, and we're going to touch more upon this later. How is the small and medium-sized company going to fund itself?
Yeah, I mean, it's a good question. I think we've seen a number of paradigm shifts coming to the market. So if we sort of quickly touch on those, if you go back to 2008, which was the first kind of iteration of alternative lenders coming into the market post the global financial crisis, we began to see pools of capital focused on what we would loosely bracket as high yield or SMEs or smaller trading companies. And a number of funds started to spring up around then, EFA and BAF and IIG and Barrack and all these kinds of guys. And they started to lend pretty much in the same way that banks had previously lent to smaller companies. And that meant doing your credit and due diligence work and so on. But let's not forget, for one, you have to do the same amount of work on a $1 million loan as you do on a $100 million loan. So you are immediately capacity constraining yourselves by lending in a traditional model that the banks had adopted previously. Second to that is new investors coming into the market didn't know what trade finance was. So, these early funds were going out and saying, what's this trade finance thing? And the funds profess it, or the managers at the time professing that this was a great asset class to come into, super stable, very low default rates. Look at what the ICC says. And so, a reasonable amount of early capital came into the space. The issue we then encountered was running commingled pools of capital in the kind of scale that the managers had back then, meant that you had a highly concentrated portfolio. So, and by highly concentrated, you probably had, 5 to 10% on one individual risk by itself, and in some cases much more. So as soon as a position like that became illiquid, and the typical hedge fund investor wanted to pull their money out of the vehicle, this created quite a problem for a lot of those early managers. And then subsequent to that, going into something like it, I suppose, problems are covered over by the twigs of liquidity as you start to grow forward, and very much like funding any counterpart, when you have a market shakedown, those twigs of liquidity are brushed away very quickly, and then the problems that sit beneath it are unearthed. And we saw that fast forward to 2020. Obviously, we saw that in a great number of cases. So, if you really want to, what I'm trying to get at, if you really want to try and finance SMEs in scale, it's very, very difficult to get that amount of capacity if you're going to lend in a traditional banking model and you're going to try and then shoehorn that into a traditional hedge fund model. Those two things don't really are not very good bedfellows. So what is the main issue confronting any SME? When a small company comes to us and they say, okay, look, here are our credentials, here's our financials, this is the story, these are the flows that we're engaged in. It takes around 3 to 4 months before you can lend them any money. I mean, that is a highly inefficient bottleneck to try and get new sources of capital into the market. So lenders really need to adopt a different way of or a different perspective, or call it trade finance 2.0. And really the only way to do that, we feel, is by assessing each transaction as a trade as opposed to a loan. So you step into a structure as having control over the title, or do it as a repo, and then you're going through a process where you're assessing a trade rather than assessing a counterparty as a whole, and thus cutting down significantly on a bottleneck. And again, really distribution to that many SMEs out there really needs to be done through comprehensive digitization. And then that brings us into a broader issue, which is user acceptance. You know, there are so many systems out there where they're trying to consolidate the market or trying to offer something else. So it's very difficult to capture that sector comprehensively. And that's why you've seen, with retrenchment of alternative lenders, retrenchment of financing banks, the trade financing gap, or the liquidity hole that sits in our global market. You know, pre-COVID was estimated to be about $1.5 trillion, which is larger than the entire global corporate debt market. You know, my last conversation with the ICC, they now see that probably doubled. So this is a real problem for these smaller investors. But moreover, for lenders who want to get to them, it's a capacity issue. I mean, Aaron can come and provide as many wraps or credit insurance as he wants on SMEs, but it's really, you know, solving that capacity issue to plug that gap. Banks, as we know, trade finance traditionally in investment banks has effectively disappeared, and it's become an investment grade corporate lending game, which is now over competitive. So, you know, Trafigura can get $5 billion away at 25 basis points, syndicated with 50 other banks, you know, quicker than you can go and buy a pair of socks. So, you know, it creates, again, one of the reasons why these big merchants had such a bumper year in 2020 was they were able to put themselves in a situation where there was very little to compete with their ability to raise finance, have a very, very low cost of capital, and be very aggressive and unrestricted on the way that they could use that money. So, you know, for the smaller niche player, it really presents significant issues going forward this year and the years ahead. And the only way that I can see, you know, comprehensive adoption by or finance provision to these smaller companies is not by taking those traditional bank lending models, not by doing this whole 6 months credit review and spreading financials, and you know, honestly it's irrelevant, because what you have is, you know, I came from a trading environment where if I did a deal with someone on the phone and I said done, I put the phone down. I didn't need to go and get Reed Smith to do 150 grand's worth of work and 3 months of legals just to know that that deal was going to be executed, because there was the unwritten rule of the gentlemanly way of doing business. You cannot do that with SMEs. The fact is that good people don't need any documentation whatsoever to ensure that they pay you on time. But transversely, you can have the most comprehensive credit work and documentation known to man, and bad people will still be assholes and still try and screw you.
That was eloquently put, and you know that creates a few questions in my mind. First, question number one: if the market is so open and wide to the tune of 3 trillion, meaning that the gap is in fact widening, then pricing should be quite interesting, and then that should automatically drive investor interest towards this market and these solutions. I mean, do you see that in your business? Are you easily able to go out and raise another $1 billion or $2 billion of funds to plow into the industry?
I mean that's a multifaceted question. I'll do my best to summarize it because it's a multi-headed hydra, that one. The traditional investors who backed the trade finance story, I guess to the tune of maybe about $8 or $10 billion over the last 10 years, were the people that any type of any hedge fund that was launching would go to: multifamily office, early stage investors, some insurance companies that had more scope in terms of the risk books, etc. But what we've seen is a massive array of these managers gate and go, or even go under, and that scared a lot of people away from the market. I don't think that raising money in an open-ended fund in the traditional sense is going to be a task that's easily accomplished. I mean, I can tell you that in 8 years of running Kimura, I've done over 3,000, and I'm not exaggerating, I've done over 3,000 investor meetings. And the hit rate and the ability to raise money from the street is incredibly low in relation to the people that you see. So where does the new money come from? Where is the new source of capital going to come from? And how best can an alternative manager or how can our market present itself in the right manner in order to access this capital? Well, you have a number of factors. First of all, you have around $5 trillion globally sitting in money market funds earning zero. So trade finance as an asset class as a whole should be incredibly attractive to typical cash management players, insurance platforms, corporates, etc. But how do we do this? How do we create a product that's attractive enough for these people to come in? One of the major issues is obviously capital treatment with insurance companies and Solvency II, and you can get around that by wrapping a product, creating a note, having it rated, etc. But then you fall into another issue: is it's an illiquid product. You know, you can't comprehensively finance a trade finance portfolio with any better liquidity than 90 days. So that pushes, again, that then anything beyond 90 days gets a harsh treatment in terms of Tier 2 capital ratio. So we need to come together, and we've seen a number of these initiatives actually begin to get a footing. Trade Tech's quite interesting. I don't know if any of you are aware of what they're doing, where they're effectively selling down bank risk, which is wrapped and rated in notes. I think that type of business or that type of product for investors going forward is an attractive way of doing things. There are a great number of credit funds or distress funds that will always co-finance. So you can always call, an Oak Tree or a White Oak or one of these companies. If you have an interesting risk-adjusted position, they'll always want to step into something like that. So we've seen certainly a significant growth in that particular arena of funding. And there is, as I said, a huge demand for a product where insurance companies and corporates can manage their overnight, where they can have something that is insured, wrapped and rated, where they don't have a harsh capital treatment on the balance sheet. But we need to be very careful. Again, seeing companies like Carlyle do this in the early days, where they issued a whole bunch of notes, not really understanding how trade finance fits into. You can actually have, the underlying collateral that you're funding change in value. Who knew? So that can dramatically change the credentials of those notes that are being funded. And Carlyle had a terrible time doing that. So we have to learn the lessons of the past, and we have to, as an industry, stop thinking that we can do things the old way, because it does not work, and we must change and offer the products to the market that we need to be. We don't need to be beholden to what the borrower needs. We need to be beholden to how to get liquidity into the market. Once the liquidity is in there, then we can manipulate it in such a way that suits the the counterparties.
Yes, I wonder actually, doing things in a new way. I mean, Greensill is a obvious example that comes to mind. It's a company that came out of nowhere in a very short period of time. Managed to create this new instrument, if you will, that proliferated, and it attracted the attention of investors outside the commodity industry. And in fact, it was a little bit going back to wrapped rated products. And the assumption that security can be found on a piece of paper that actually wraps something else. And I wonder actually if that is the way forward. Is this the right way forward? Or maybe the merchant model, which is a traditional model, is a better way forward, because there at least there is somebody, and you touched, and Alexander touched upon earlier on that, who understands the underlying product and is able actually to follow the logistics and the securities related to it. So, maybe that's why ultimately banks end up having more certainty, to actually giving money on corporate facilities to the likes of, Trafi and whoever else, who then actually use their ability and market knowledge and local presence, importantly for the commodity industry, to push down liquidity to the market. I mean, is this a way that, Alexander, you see commodity companies developing going forward, playing more the role of not just of the merchant, but also of the merchant banker?
I mean, absolutely, yes. I mean, this is something that has happened already years ago, and already, in a pre-COVID environment and before all these fraud cases. But again, fraud cases have a long history in commodity finance. Just to reflect, I think, I heard the name of Jingdao earlier today, so that was also from a repo perspective back in the days. And, it's a repetitive. So this risk will ever be present, and it's a virus of its own. It's not COVID related. So this is something, when we speak about classical trade finance instruments, they should mitigate that. Because, one component and one dimension of Greensill that I read out of the press was that we're pretty much funding perceived receivables, future receivables, which haven't been invoiced yet, So this pretty much defies the theory of trade finance, which is actually transactionally secured finance. So for me, as an expert, that would entail, unsecured lending. And this is exactly what banks are shying away from, and pretty much also asset managers, because even asset managers who used to tap into, the trade finance market have been hit seriously and severely, in 2020 and 2021. So pretty much the idea is, back to the roots of trade finance, and the essence of trade finance is, to have a self-liquidating, transactionally secured funding, where we see also, a strong function of private equity, of funds, of alternative funding is. Just look around, we are pretty much all placed, in the beautiful canton of Zug, including our company and the likes, and it's no secret, it's all public domain available information. Look at the likes, of Varo Energy here in Ham, which is, as we know, partly owned by Carlyle Group, or Met Group that recently has onboarded another investor, being Capital Corporation. So technically, where I see a very strong function, in the commodity space by funds is not really extending, trade finance instruments, because, the hurdle rates that you're looking for would be very difficult to accommodate in a classical trade finance deal, which yields probably, 1 to 5% gross margin in average. Now, we can have, philosophical discussion on that, but that's not for this forum. So technically, what funds can do, and they are doing, is to step in as an equity sponsor to an existing business, to level up the equity of the existing business and make it more attractive, to traditional bank lending. to increase the size of the balance sheet and obviously reduce the cost of lending. So this is something that has worked well in the past, and we see more and more. Speaking, about Greensill, as we know now, the American industrial partners have bought most of the senior debts, from Sanjeev Gupta's European aluminum assets. So on the asset side, I see more and more involvement of private equity and funds in general. In the classical trade finance instrument, lesser so, because again, for some producers that may work, which have, a very high gross margin that they can share, with the asset managers. But other than that, for classical trade finance instrument, pricing is key. And obviously, the perception of risk, secured versus unsecured funding.
Thank you. That's a very strong analysis. I wanted to touch upon the issue of private equity funds that you mentioned involved more on the asset side of the equation. I mean, we've seen a lot of companies moving that way in the past. When I say companies, I mean traders. Even Varo that you mentioned, I mean, is not a pure trading company. It has pretty significant asset side, that it trades around, be it refineries or terminals or gas stations. I mean, how important is it going forward for the trading company to actually expand its remit to include such sort of asset-heavy investments?
This is definitely, at the future of trading, because, the classical trading, and again, I've been more than 30 years in the business, at my early days, doing spot trading, that was pretty much it. You go either long or short, which is pretty much, the essence of commodity trading. But other than that, nowadays, if you do not invest into industrial assets and trade around these assets, a trader will lose its function. So just for instance, buying on the metals realm, buying LME product and selling in the market, the spreads are so narrow that at the end, probably, the cost of funding, we will diminish, any P&L created with this trade. So technically, that's what we've seen also in the market recently, that even Glencore has shown that, with the Xstrata merger, making a lateral move from a classical trading house into a producer, and other large companies are doing the same. Trafigura investing into Rosneft asset in the Arctic, and just to name a few examples. So in order to maintain their key function being embedded into the supply chain, traders will have to do one or the other investment into industrial assets, because classical trading, buying and selling cargoes, for a premium, that's pretty much non-existent, or the margins you can generate with such a business are very thin. On the other side, you have to leverage your balance sheet a lot for that.
But it is also the case that moving away from the core business, which is trading, and into a sort of long dated business, which is the asset ownership and operation, is not something to be taken lightly, because we've also seen companies going down, partly because of those investments, and also partly because of the wrong setup of their finances around it. Typically funding long dated assets with commodity trading style facilities is not ideal. So and we've seen that a number of companies that went down that way actually also ended up in trouble. So there is no holy grail, I suppose, when it comes to strategy. How do you actually manage that, the downstream investments, the upstream investments versus the trading strategies?
I mean, you obviously, as a trading house, you need to understand the momentum the industry is in the industrial cycle. So obviously, as we speak now, starting to invest into coal assets would be definitely the wrong investment. So at present, we see a lot of companies investing into renewables, being part of the energy transition, our company as well, so we are also making a lateral move into production of nickel powder for electric vehicle. Has been, it's also public domain information. It has been published in the Metal Bulletin. So we are at the forefront as a metals business at energy transition, and equally as an oil and gas business, focusing more on clear energy. So an entrepreneur, a trading house needs to understand, what's the commodity cycles, which commodities, what's the commodity mix in your portfolio, where you need to upsize, where you need to downsize, because again, we've seen back in the past huge investments into coal mines, and then obviously in the middle of energy transition, these assets become redundant, and equally to fund such an operation, you would probably need to back it by a 10 to 20 year loan, but then after 5-7 years your business model becomes obsolete and redundant. So this is where investments need to be taken. And again, also now with the entire ESG hype, it's not all renewables are profitable. So it's also, from an investor's point of view, which one will you pick, which will take off, and what's the right investments to be made. And again, it's not like a no-brainer, just invest into renewables and you make it worthwhile. So that's definitely not the case, because even you mine critical raw materials now, but tomorrow by way of innovation, the structure of the electric vehicle batteries may change. So the idea is once needs to be like really a trading business has to be like a chameleon to some extent, to easily adapt to the environment it's trading and operating in.
So that actually, you look at trading, you look at asset investment and infrastructure investment more like a trading activity, on long-dated sort of assets, basically, because
That's
you need
correct.
to be nimble enough to move in and out of assets as you move in and out of a trade, I suppose. Although that's not always as simple. But it's interesting you touched upon ESG, because ESG, of course, is in everybody's agenda to a greater or lesser extent. And how do you determine as a company, and I would also like to ask Chris the same question, and how do you determine as a company the importance of ESG, and how do you also decide how to spend your resources and on which ESG items to focus on? Because obviously you have environmental, you have social, you have a number of different topics that you need to focus on. Is there a methodology that you use in actually focusing on one versus the other, or is it simply, again, focus on profitability and what gives you the best risk reward?
Obviously, as a trading business, we are doing what we do best. So capitalizing on our expertise. As we speak, Air Resources, is the second largest independent nickel trader globally. So nickel is our game. That's the metal we have strong experience in. And even, with the energy transition, we are staying, in the product group, and it's a related product. It's a derivative of nickel powder, obviously. So we have a strong market intelligence on this product, and we understand the mechanisms. So even, moving now and being at the forefront of the energy transition is placing us in a product range, which is our experience. So what I definitely, would not recommend to any traders, just jumping on ESG and say like, okay, we want to be part of this transition, but then stepping, into a product group the company has no prior experience with. So that's obviously a risk. So, whatever recalibration you do, within your portfolio, but keep, back to your roots. What's actually, your core business, and don't move away too much, from your core business.
Chris, would you like to comment on how ESG is affecting, your business And more generally, we've seen investors playing a bigger role in determining the policies of corporations around ESG matters, and even pushing them to move in and out of sectors. I mean, do you see that happening at your level in alternative finance? Is it a consideration?
Yeah, I mean, so who are our customers? Our customers are really our investors. They're the ones who decide whether Chimera lives or dies, whether they give us the money or not, basically, to manage on their behalf. There is not a single institutional investor out there that hasn't asked for our sustainability policy, that does not now require us to have a very detailed plan for not only ESG, but also create metrics around the impact that the capital is making. However, I'm going to say a couple of things that might chime slightly controversially with you, but I'm going to caveat it with Chimera Capital is the only asset manager in the world who is represented on the ICC Sustainability Council. So we do, it is the core of our business. We developed a highly detailed auditing system long before it was cool. It had always been part of our assessment when we're looking at risk. Just generically, what is the welfare of the workers? Are they damaging the immediate environment around them? Is the governance of the business good? So obviously companies that typically score better on an ESG audit are ones that you want to lend money to in any case. However, that brings me on to a slight bit of controversy, and that is the concept of energy transition. Now, over here in the UK, the government have given us a wonderful incentive scheme to switch to electric vehicles. Great, less pollution on the roads. I'm definitely a big supporter of that. But let's not forget, the energy industry produces less carbonic gases than agriculture. So I don't see that amount of drive being pushed for everyone to become a vegan overnight. But in any case, but secondly to that, if we all move to electronic vehicles, where are we going to get the energy from? Where's it going to come from the grid? Is it going to come from wind turbines? No. Is it going to come from solar? No. Where's it going to come from? Oh, let's burn some biomass. Okay, well, that's 4 times more carbonic than burning coal. So, you're not really solving an emission issue straight off the bat. But then what comes into play is the cost of that energy that's being produced. And the S in ESG is you're then going to start to disadvantage the poorest of communities, the poorest of families, when you say, sorry, you can't burn coal anymore to produce your electricity. I know it doesn't pollute as much as wood pellets or us digging big holes to produce batteries for this and solar panels, but I'm sorry, you now have to drive electronic vehicles and you have to pay more for your energy. So there comes somewhat of a conundrum, and I would ask all of you to have a little bit of research into what the Japanese are now doing with their plans for coal-fired power stations, seeing that the fact that the market is going to crap out in terms of people willing to finance and willing to provide what will become by far the cheapest energy resource. So it really should be about what is their treatment of exhaust gases? Do they have scrubbers? Do they have catalytic conversion? How are they treating this? Because there is obviously when the consensus of European banks get together and say, right, coal is bad, coal is evil, let's not finance coal anymore. Like most of these things these guys come up with is a terribly poorly thought out piece of legislation that really needs looking at in a lot greater detail. So circling back to our perspective, ESG without a highly detailed sustainability policy, without an ESG auditing system, you're not going to get any new money from any investors. And so that's what so you do have to toe the line to a certain degree. However, it does frustrate me that there is the lack of the common sense element in actually defining what is good and is bad. Just because Saint Greta says something's bad, it's now all bad, without really assessing the knock-on consequences of something. So we're still in our infancy in really understanding what ESG is as an industry collective is what I'm trying to get at. And there really needs to be more effort and more time and more commitment. And I know, traders don't really want to hear it because they want to be focusing on their core activities. And look, we dig big holes in Africa and we make money from the stuff we pull out, and great. But we all need to come together and we all need to address ESG as a whole. We all need to just be better at being good people, not damaging the environment, making sure the welfare of emerging economies, of the resources that the industry is plundering, are looked after, and they get to move forward as a society. And of course, you're never going to lend money to a company that has poor governance anyway. So for a lender, GE tends to be the most important, and for a trader as well. But we really all need to take some serious looks in the mirror and make some big advancements.
Yes, it's a very good analysis, actually. It's almost refreshing, I would say, to hear somebody talking in those terms. We used to call it, when I was running the ECT business in Vietnam, we used to call it trade, not only aid, which is exactly what you described, Chris. But nevertheless, we still have greenwash, we still have the sustainability wars and political wars going on about it. We have, the US government announcing their 2050 agenda to reduce carbon emissions by 50%. And for shipping, mind you, they want to do 100% reduction by 2050. The UK announced similar measures with net zero policies. And the EU is, struggling to come up with a taxonomy to actually define what is sort of a green investment and what's not. And I'm afraid that we're going to be buried under a lot of acronyms without actually giving sufficient attention to the essence of it all. But nevertheless, we have to do it. How does the investment community that supports the insurance industry look at those issues, Aaron? I mean, is it part of your assessment process to look at the ESG policies of companies, or not yet?
So actually, we conducted, if you will, a market review late last year, because with ESG becoming such a hot topic, we wanted to actually see what's out there. And it became very quickly apparent to us that there was very little being done. The one thing that has been done is the negative, as in the big insurance companies such as Allianz and AXA effectively said, we do not touch coal across whatever is the risk. We just don't want to do that. We put the question back to them, well, that's great, but what are we actually doing on the positive side? The response was, not very much. And the feedback we got is, look, at the moment, nobody's linking our financial performance and our incentives to having any ESG matrix. So it became very clearly apparent to us that until somebody from, if you will, upstairs goes to the underwriters and says, look, you have to incorporate ESG assessment into your risk assessment, not much is going to change. Now, where the change is going to come from is a great question. What I suspect we will see is, if you really think where the capital flow of the insurance companies is coming from, it's pension funds, right? So it's long tail companies who are just going, look, provide me a stable return. Because that's what insurance is there for. I think, and we've seen this already, if you think about it, a lot of the money that you effectively have in your pension pot is probably sitting in an insurance company without you really realizing it. So I think you're going to have a groundswell from the younger generation, the people who are a bit more aware of what's going on, and they're going to start asking questions and making sure that their passive pension pots being put into insurance companies are actually being used for the ESG, world. What does that mean? How does that look? When will that take effect? I don't actually know. I don't think anyone knows the answer yet. I would say it would take probably another 5 to 10 years, because if you think banking is a slow moving industry, insurance is even slower. But once it moves, it moves. So if you think about the capital that sits within the insurance companies, we're talking trillions globally. And if they decide as an industry to move the needle, it would actually make a big impact on all other asset classes sitting below that. So it's an interesting journey. What we're starting to see actually when we looked at it is some of the banks now have incorporated ESG into their funding metrics and into their pricing. So we have seen banks who effectively start putting ratchet clauses that says if you hit whatever it is that they set in terms of an ESG goal, we reduce the funding cost. And that isn't filtering back into the insurance industry where they're going, well, I'll match you 1-for-1 should you follow that. But then again, that is, just a drop in the ocean. So I think a lot will happen in the future, but what is it going to look like? We simply don't know. And I think the key instigator again is to have incentivization linked to individual performances and bonuses and pay posts, because that's the only way that people move. If somebody tells you from upstairs you need to do this, that's all fine and well, but until it hits your personal pocket, I don't think we're going to see much movement on that.
Yeah, I see what you mean. It's actually, it isn't. I read in a paper recently that the sort of ESG is probably one of the most important opportunities for the commodity industry going forward, and probably that touches upon what Alexander described earlier about how their core business is nickel, but now they're looking at adjacent opportunities to their core business, and they're trying to take advantage of it. I mean, what other opportunities do you see for trading, around the sustainability and importantly the decarbonization drive that we are currently experiencing, Alexander?
Obviously, critical raw materials will be there. There are also, certain byproducts, such as cobalt, so we will definitely also engage in that, because in certain production area, it's a byproduct, but equally a good material, to be used, to be part of the energy transition and address a variety of clients, in the electric car vehicle. As we know, that's brings, completely different, corporate governance benchmarks, because as we know, the entire electric vehicle industry, heavily regulated, high compliance standards, and one definitely has to adhere to that, so that's why we have also, internally the stricter, corporate governance standards, to be able, to compete within this industry. On the oil and gas side, also, looking, into clean energy, to touch upon that, what as Aaron has explained us. Also, we see this in the banking sector that, for instance, if you have X amount of dollars available in terms of funding, you need to provide a mix of products, including clean products. So there is also, a strong push, from the banking sector, but it's also rewarded in a way that reduces, funding cost in general and provides, more generous in terms of limit availability and capacity, but equally also in flexibility of funding. So we are also, quite actual. So we are significantly increasing our exposure to natural gas, LNG, and other clean products. And also we will at some point, activate, in the renewable fuels desk.
It's interesting that you mentioned gas, obviously, because gas has been touted as the transition fuel, as we move away from coal and oil into something cleaner. But there was a report, I think it was the World Bank or a couple of days ago, that came up with a report saying that actually gas is not cutting it, because if we now invest in infrastructure that supports the gas economy, whether this is plants gasification or liquefaction, I don't know what, pipelines, etc., and of course distribution networks. I mean, this is not really going to be an investment that's going to pay off, because in 10 years from now we're going to be talking about assets that are not going to be needed if we really aim to go towards net zero emissions or very significant reductions by 2050, which are obviously required. So how much of a risk is this for companies that have invested billions of dollars into so the gas economy, whether it's LNG or natural gas, going forward? And are we really seeing a major risk for kind of stranded assets in 7 to 10 years from now?
I mean, the risk is there. I think just the investment thesis will have to change. So obviously, as an investor, you will look into return on your equity, and also in terms of an investment, what's your payback period? So if you invest into an asset and you have a very quick payback period on your investment of 2-3 years, so we'll probably everything beyond that horizon is just contributing to your P&L. Today, investing now into upstream, into crude oil and other products, which definitely may be abandoned over time or restricted in a way that, as we are seeing it now in the coal industry. And again, also even the coal, like also Christopher, just mentioned, in certain regions, you cannot just detach coal from one day to another. As we know, even China is still highly dependent on coal, Japan, Germany as well. So a lot of economies who definitely want to be part of the energy transition, but in order, you cannot just switch off the light, from one day to another. So you need really to phase it out over time, like we've seen also, like with nuclear energy in Germany, to also state this example. So there is going to be a transition period. So how quickly this will happen? And again, we are now speaking about electric vehicles. What if, by way of innovation, in 5 years' time, the metal mix within the batteries will change because we find better way to exploit, on the investment, or their heavy investments now into hydrogen and to other products. So again, similar like with a combustion engine, that's now slowly being pushed out of the market. In 5 years' time, this may happen even with electric vehicles. So there are another cheaper source, which is easy to refuel or to recharge, to be more precise, will come across. And then obviously the entire energy mix will change, rapidly.
Yes.
I think, Harris, the one thing not to underestimate is, the importance of government subsidies, because when we run all these models, we're assuming that, this is just traditional business, that we need to make the return equity to work for everyone. But if the governments are coming in and spending billions and trillions on it, and it's a case of getting us across the line as a transitional fuel for the next 10 years until the next thing comes along, I think the investment might actually justify itself.
Absolutely. And the question is, how do you then position yourself and your company to take advantage of those, subsidies and significant investments that the governments around the world will be giving to achieve that transition? But I think we're caught between the rock and the hard place, because on one hand, we are incentivized positively or negatively not to invest in existing technologies or fuels. And obviously that creates, again, a dearth of investment and underinvestment in those industries, which then creates significant, shortfalls in output. And we may get caught with a situation that, in fact, there's not going to be enough oil for, in 2 or 3 years from now to support the economic growth needs for the world, while we're looking for the alternative fuel. So it's not an easy equation to solve. And I think this is exactly what, commodity trading companies that are, well entrenched in the market, and they have their antennas, and they're good at feeling, the environment and the changes, should be able to do. So actually, I'm just thinking whether they should be able to also provide guidance as to, what's happening, and through associations like the two commodity association, sufficiently, lobby governments to take the right decisions for the world and for trade. I'm conscious of the fact that we're running towards the end of the, this webinar. It's been very interesting. I wanted again to ask if there's any questions from the audience. Please, raise your hands or type it in the chat box for us. I see one question from Murad, who says that the surety bond cannot be claimed on first demand, and this can be an issue for a beneficiary to accept such an instrument compared to a bank guarantee. What can you just comment on that, Iran, if you don't mind?
Yeah, so a surety bond can be structured in different ways. So you have conditional bonds and you have unconditional bonds. It's very much a discussion to be had with the insurance company to make sure the bond issued is relevant for the type of guarantee required. So the short of it is possible. You do have unconditional surety bonds being issued. I mean, we're working on several right now.
Great. Okay. Any questions from our board or from Martin, perhaps?
Yes, please, if I may so. One question to Chris, and basically, what are the, well, let's say, ideal clients or potential lenders that could approach you? Which size or which setup or which commodities or?
Yeah, well, I mean, look, we're totally agnostic to. I mean, we can be a day one lender to a brand new company if we know the people involved, we know the underlying market, we know their customers, and we're comfortable with the transaction. I mean, the two most important questions for a lender is, how do I perfect title and what's my security interest? And then you get on to, am I being overcompensated for the risks that I'm taking? So if all of those things line up as a tick, then you can move ahead with a transaction. We don't like things like commingled inventory. That tends to bring its own challenges. Of course, on a vanilla basis, you want international water trade, all this kind of stuff, but there's still, you still find traditional lenders are out there to do very vanilla type trade finance business. So that what they want us to do is the dirty work. They want us to do the inland, the tricky bit, the transit, the deliver at frontier, and all of that kind of business, which is fine as long as I said, those three initial questions all line up and are favorable to us. We tend to focus on strategic commodities, energy, metals, and agriculture. But we have built a future materials product, so we're looking more at battery components and where we could potentially help that section of the industry. That's actually got a lot of interest from investors. On the whole, we don't really get restrictions from our investors unless they are coming from the Middle East and you're all subject to Islamic financing conditions. And quite simply put, that's basically no piggies and no parties. So you can't finance pork or pigs or alcohol or tobacco. So no piggies or parties tends to work for those guys. But you want to be engaged in a product that's a flow product, and you have a generic proxy. So if you end up having to enforce, you can liquidate.
Liquidity once more.
Good.
Okay.
Well, I think we've reached the end of the time allocated to us. It's been a real pleasure to have you all here. I mean, it was a very interesting discussion. It seems that there's abundance of opportunity out there, and given the recent stimulus packages and the economy is coming out of sort of the COVID crisis, it seems that we're entering into a very interesting phase. Somebody called it the Roaring '20s again. So let's just see whether this is going to be the case. Thank you all very much, and in particular our panelists for their participation. Thank you, Andrea, for putting this whole webinar together, and we look forward to hosting you on the next one. Martin?
Yeah, allow me two last words. First of all, I noticed there were a great audience today and very many participants who are not representing a member of ZCA. So please encourage your company to become a member of the ZCA. And secondly, I would like to make you aware of the next event, which is on Wednesday, 5th of May, which is actually the day of our 2-Commodity General Assembly. And after the formal part, we have a presentation by Jeff Curry, who is the head of Global Commodities Research at Goldman Sachs. And I believe Goldman Sachs just recently published a study, an article about the start of the next super cycle on commodities. So I expect or hope this will be a very interesting presentation, and I encourage you all to participate on that one as well. That's all from my side. Thank you very much to all the participants, to the panel, and to Harris to have organized today's event.
Thank
Thanks,
you.
and have a good day.
Thank you very
Bye.
much, guys.
Have a good day. Bye.
Thank you.